Today we are going to look at the candlestick patterns. We have 11 types of candlestick patterns, but today we are going to look at 3 of them. And the first one will be the amplifying bar candlestick pattern, the bullish amplifying bar candlestick patterns, and the doji candlestick pattern. Candlesticks are one of the most powerful trading concepts. They are very simple, easy to identify, and very profitable setups. A research has confirmed that candlestick patterns have a high predictive value and can produce positive results. Candlesticks are the language of the market. Imagine you are living in a foreign country and you don't speak the language. But if you know how to read the candlesticks the right way, you will be able to understand what these patterns tell you about the market dynamics and the traders' behavior. This skill will just help you better enter and exit the market in the right time. In other words, it will just help you act differently in the market and make money following the smart guys' footprints. Candlestick patterns that I'm going to show you here are the most important patterns that you will find in the market. And in this chapter, I am not going to show you how to trade them, but this will be explained in details in the next chapters. What I want to do is to focus on the atom of the patterns and the physiology behind their formation, because this will help you get the skill of identifying easily any pattern you find in the market and understand what it tells to do next. If you can get this skill, you will be ready to understand and master the trading strategies and tactics that I am going to teach you in the next chapters. So let us look at the first candlestick pattern. The first type of candlestick is the amplifying bar candlestick pattern. The amplifying bar, as it states in its title, is formed when it fully engulfs the previous candle. The amplifying bar can engulf more than one previous candle, but to be considered an amplifying bar, I repeat, the amplifying bar can engulf more than one previous candle, but to be considered an amplifying bar candlestick, at least one candle must be fully consumed. The bearish amplifying bar is one of the most important candlestick patterns, and it consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. You can see in the illustration below. In the illustration, we have the smaller body, we have the opening price and the closing price, as you may see here. This is how a bearish amplifying bar pattern looks like on your chart. And this candlestick gives us valuable information about bulls and bears in the market. I'm to give you the meaning of the bulls and bears in the market. As we continue, you are going to understand each and everything. In this case, in case of a bearish amplifying bar, this pattern tells us that sellers are in the control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. I repeat, when this pattern occurs, I mean this pattern, when this pattern occurs at the end of an uptrend, it indicates that buyers are engulfed by sellers, and it indicates a trend reversal. You can see in the example below. We have a bearish amplifying bar, as you may see. We have the opening price and the closing price. As you can see, when its price action pattern occur in an uptrend, that is the uptrend, we can anticipate a trend reversal because buyers are not willing, are not still in the control of the market, or not willing to control the market. And the sellers are trying to push the market to go back down. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm your entries. As we will talk about this in details in the next chapters, right now I just want to open your charts and try to identify all bearish candlesticks that you will find. Let us go to the second candlestick pattern, and it is called the bullish amplifying bar candlestick pattern. The bullish amplifying bar consists of two candlesticks. The first one is the small body, and the second is the amplifying candle. You can see in the illustration below. This is the bullish amplifying bar. The first one was a bearish amplifying bar, and the second one is the bullish amplifying bar candlestick pattern. And this is how it looks like. It consists of a smaller body, the closing price, and the opening price. The bullish amplifying bar tells us that the market is no longer under control of the sellers. It just tells us that the market is no longer under control of the sellers, and the buyers will take control of the market. When a bullish amplifying bar candle forms in the context of an uptrend, it indicates a continuation signal. I repeat, when a bullish amplifying bar candlestick forms in the context of an uptrend, it indicates that here is a continuation signal. That is the bullish amplifying bar candlestick pattern. When a bullish amplifying candle forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom When a bullish anglifying candle forms at the end of a downstream or a downtrend, the reversal is much more powerful as it presents a capitulation bottom. You can see in the illustration below. That is the illustration. We have a downtrend there, and it is called the bullish anglifying back candlestick pattern. That's how it looks like. You can observe very well. The example above shows us clearly how the market changes direction after the formation of a bullish anglifying bar pattern. You can see the formation. The market changes after formation of a bullish anglifying bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. You can see the color of the bodies. The color of the bodies is not important. What is important is that the smaller one is totally engulfed by the second candlestick. Do not try to trade the market using this price action setup alone, because, listen very carefully, do not trade the market using this price action setup alone, but you will need other factors of confluence to decide whether the pattern is worth trading or not. I'm going to talk about this in the next chapters. What I want to do now is to get the skill. What I want you to do now is to get the skills of identifying the bearish and the bullish anglifying bar candlestick patterns on your charts. This is the most important setup or step for this moment. And let's look at the last candlestick pattern for today, and it is called the Doji candlestick pattern. The Doji candlestick pattern is one of the most important Japanese candlestick pattern. When this candlestick forms, it just tells us that the market opens and closes at the same price, which means that there are equality and indecision between buyers and sellers. When it occurs, it just tells us that the market opens and closes at the same price, which means there is equality and indecision between the buyers and the sellers. There is no one in the control of the market. You can understand this. When this pattern forms, neither the buyers or nor the sellers are in the market. It means that no one is in the control of the market. You can see the example below. This is how a doji candlestick looks like. We have the highest price, the closing price, the opening price, and the lowest price. And let's see what they mean. That's how it looks like. It is called a doji candlestick pattern. As you can see, the opening price is the same as the closing price. You can observe very well. The closing price is the same as the opening price, or the opening price is the same as the closing price. This signal means that the market did not decide which direction it will take. This signal means that the market did not decide which direction it will take. And when this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. It indicates that the market is likely to reverse. You can see another example below to get you understanding more. Here it is in the uptrend. It has occurred in the uptrend. It means that buyers and sellers are no longer in the control of the market, and there is indecision between them. You can observe the chart very well. That's how it looks like. The chart above shows how the market changed the direction after the formation of a doji candlestick. The market was trending up, as you can see. The market was trending up. That means the buyers were in the control of the market. The formation of the doji candlestick indicates that the buyers are unable to keep the price higher, and the sellers are now pushing the prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji candlestick patterns indicates equality and indecision in the market. You will often find it during periods of resting after big moves. It may be higher or a lower move. When it is found at the bottom or at the top of a trend, it is considered as a sign that a period trend is losing its strength. So, if you are already riding that trend is time to take the profits. It can also be used as an entry signal if it is not combined with other technical analysis. I think that is enough for today. I will be seeing you in the next video. In the next video, we shall also look at 3 more types of candlesticks. Remember, I told you we have 11 of them, and today so far we have got up 3 of them. In the next video, we shall be also looking at 3 of them. Yes, I'm waiting for you in the next video.